Guys, welcome back. Sorry about that. I had to put it off because I need to record this, to re-record. Right. Okay, so good enough, you're back, so you're here. Interpretation of the question. I will encourage you, whenever you meet any question like this, very long, before you read it through, just try to look at the required part and you see if the questions make sense or if you maybe have a clue of the topic. So in this case, I shall just go through a few. The saying discuss reasons for valuing a company's share other than for listing purposes. Okay, now listing is the process through which a company goes through in order to have their shares listed on the stock market. Or in short, for a company to be, you've heard of Uganda Stock Exchange or Uganda Security Exchange, something like that. Okay. Now, for companies that are listed, which most big companies are, if you're big, then you should be listed because of the advantages that come with, especially on buying and selling of shares. We say that any company, for it to be listed on the stock market, is supposed to be valued. That's why we do the valuation. So that's one of the reasons. Now, the other reasons, we are aware that, for example, if you want to have a takeover or if there's a merger, okay, in case you want to merge with another company, you want to know your value and you want to know the other's value so that you know what's coming on board. The other is if you want to sell off your company, you want to value it so that you know how much you're worth to enable you bargain quite favorably. What would be the other reason? Those among others. You may be having other reasons, kindly feel free to share. So there are 4 marks. Maybe if you give 2 and explained to be good enough. Then the other one where the marks are, I think it is advise management on the value, okay, of the entity. So we are aware this is company valuation. Okay, so ideally, if you wanted to value a company based on the net assets valuation model, so you're aware what to do. You get total assets, okay, total assets, the non-current and the current assets, have them valued. And usually we consider the net realizable amount, unless there's any other, unless otherwise, that's when we use things like replacement cost and the cost method. Okay, but preferably it's net realizable value because it gives you the actual happening or the current standing of the business and its current assets. Then from the total assets, we deduct total liabilities. And still for liabilities, you take in consideration any liabilities that you could have that could have been foregone or that the company will allow you. For some reason, the supplier says don't pay or gives a discount, whatever the case may be, you take into consideration that as well. Because there's any fine you need to pay, okay, all those you include them. So you have total assets minus total liabilities. The figure you come up with, we say that's not net assets and that's the value of the company. However, that's on the based on the computation. Then we add in a few other margins, or say what you call safe margin. If you have anything like an intangible asset, like a value of intangible assets, which you normally include like maybe goodwill, maybe a list of customers that you could have had, maybe the good location of the entity, among others. So that value must be incorporated into now the value that you've computed. And that's how we end up with now the real value of the company. So having said that, we shall see how we work out that. Then part 3 says evaluate the limitations. We're using net assets and then cash flows. For cash flow valuation, we know that this is really, we discount the cash flows. Cash flows are future, we normally use future economic not economic, but future cash flows that we expect from the company, and then we discount them to today. Okay, what we call present value. So that present value is what we use as the value of the entity. Now, we say what's the advantage between the two or the disadvantages accordingly. Now, for cash flows, because we use forecasted cash flows, you're looking into the future. We're saying that there are so many things involved, like maybe inaccuracy, for instance. Okay, because this is not certain, you have not incurred the cash flows yet, whether incurred or received them. So how accurate or how should we say how authentic, yeah, are these values? Okay, so there's that risk that whenever we just estimate it. So the one limitation that it has with cash flows is that it's a forecast. Okay, now because it's a forecast, it has things like risk and uncertainty. Then the other thing is you want to come up with the right discount factor or discount rate, which is also subjective in nature, that may either based on the industry discount rate, or you want to depend on the existing cost of capital, among others. So the fact that it's subjective, it makes it difficult. Eh? Now for net assets, what stands out most is the fact that it uses historical data, which is a limitation in my opinion, because it is history, and yet you're looking at going forward. What else could you tell me? Yes, that's for net assets. Which other? Maybe it doesn't cater for qualitative factors, such as maybe skilled management, among others. The net assets may not really cater for it, which I also think for cash flows, they don't cater for that because it is quantitative. Okay, so yeah. So let's look at the question now. Question 2, the computation, and see how it goes. Okay, so I hope you have the question because I don't intend to keep sharing it when I'm working out the answer or the final answer. Difficult sets and abilities to include. Difficult what? Difficult finding. Yes, yeah. Is it difficult to trace the assets and liabilities? Maybe yes, maybe not, because if you have a balance sheet or if you keep records, I don't think that is hard. But well and good if you can explain it, especially for businesses that don't keep records. Yeah, I think it could be very hard for you to trace the assets and liabilities. What are the circumstances? Circumstances, like I've already said one. Where now for net assets, where it's so hard for you to obtain these assets and liabilities, maybe they don't keep records. Yeah. Then the net assets approach may not work well. So you want to consider cash flows. Okay. Then the other circumstance under cash flows is if the business has not been around for some time, maybe it's just a new business, then you don't have historical data to base on still. So you end up using cash flows where you use forecast. Okay. Then for net assets, like I already said, if you have historical data, if you have your records, then you can use net assets. Yeah, so I think those are the circumstances. So let's look at the question. So this question is for net assets, don't even think twice about it. Once net assets, just do it. Why? Because for some reason you get some marks. Okay. Unlike cash flows, you're aware that you use a lot of subjectivity in terms of interpretation, all away from financial management till now. So depending on the English they bring in, somehow you're lost in there. Okay. Net assets, small firms are the disadvantage. Okay. That's fine. Yeah, I also think so, that small firms, because they don't have assets, or they have few assets, their value may be undervalued. it may be a very serious prospective entity that maybe in 5 years time may be bigger, much bigger than it is now. So measuring it now at its asset that it has may not be a good idea, or it's a limitation. So okay, so this is it. Come up with a schedule. So we're saying what's for sure is that you have total assets. Okay, I hope you can see my screen. Just try to increase the size of the details. Okay, you have total assets, so you'll be looking at non-current assets, and then current assets. Then the result will give you the total. Then on those shall deduct liabilities. For liabilities, you look at long-term liabilities. And then short-term liabilities. Or you can say current and non-current. Then you add them together. Okay. Now, total assets minus total liabilities, then you get your net assets. Okay. Maybe what's important to emphasize is all these items you have, yes, but what you have so far will be the book value as it is in the balance sheet book value or net book value. It's still fine. Then we may make a few adjustments to it, to these figures, come up with the final, and the final one usually call it realizable or realized value. What you can realize out of all this. Okay, so the first item is land and building. Personally, I prefer usually using additional information first, then I come to this later, but it doesn't matter. So you can always have whatever you want accordingly. So allow me therefore use additional information first. So it says that it is anticipated, not one, it is anticipated that the land and building could be sold off for 1.8. Okay, not 1.8, but 1,800 million. Okay, so once they talk about this, then I come and look for the item and then deal with it. So land and building, I'll come, it's the first item online, land and building, but it's my first note. Okay, so the book value, it was given as 1 million, not 1 million, but 1,000 million. Okay, so the figures are in millions. Emphasize that. Figures, GX millions. So you have 1 million, but they're saying in the note 1 that you realize 1.8 or 1,800. Okay. So if that's the case, so you're like adjustment. We can all see that it's a positive adjustment by doing this. Okay. We can all see that they must have added 800 on 1,000 to come up with 1,800. That's how we do the adjustments. Okay, so this is not 1, and you're done. Then you go to note 2. Do I have to share the question again? Yeah. Here, note 2 says that the plant and machinery, once they talk about plant and machinery, you just notice your next line to adjust. Okay, but they say that the plant and machinery have a sale value of 250 million and a replacement cost of 300 million. Okay, so in that scenario, there's nothing to think about. I've heard guys say you have two values. What do you consider? Okay, you consider the amount that they're going to give you, which is the net realizable value, the plant and machinery. Okay, so the book value is 400. Okay, but when you sell it off, or when you plan to sell it off, they'll give it to you at 250. Okay, so you're seeing it reduced, so they must have deducted 150 from 400, come up with the 250. That's the adjustment. Then you go to the next note. I hope we're together. The next note says that the statement of financial position figure for inventory is estimated to include 10% of obsolete clothes. Okay. So if you have obsolete clothes, maybe to just take you back to our working. So we're saying we have inventory, which is under current assets. Inventory. The book value of inventory is 450. Okay, then they told you that 10%. Let me share this one so that we know what we're saying. Oh, we're on the same page, right? Okay, they're saying that for the inventory that we see here, the 450 includes 10% of the obsolete clothes. Okay, 10%. So how about if I deduct that? So under our adjustments, here, we are sure of, just have a small working here because there are several notes on it. We're saying that obsolete you have 10% of the 450, so giving you 45. So ideally, it's supposed to be deducted from the 450. However, there's good news, and the good news is that partly destroyed in the store by the rats. That these clothes, the 10%, could be sold off for 40% of the book value. Okay, so meaning that someone is willing to give us some money on the 45, which is still 40%. So we're saying the scrap value, if I want to call it scrap value, 40%, okay, of the 45 is going to be given back to me. It's going to be given back to me. So meaning that my adjusting figure would be, so total adjustment or net adjustment, would be the minus 45, which ideally reduces the figure. But again, I have a return or an inflow of 18. So my net adjustment is actually negative 27 and not the entire 45. And that's what you bring here. Okay. I'm seeing so many questions here. Let's see what they're saying. What do you do with the 1,400 on the side of plant and machinery? It is a total, it's not the thingy. It's a total, yeah. Thanks for replying to her. Okay. Isn't the intangible value on plant and machinery 350? It is 250 in the question. I can just share with you lately. Net assets more, okay. It is 250. I can share the question with you shortly. Okay. Here. Not to, they said for the plant. Okay, let me first answer this one. The one was asking about the 1,400 on the side of plant. It is a total of land and building and then plant and machinery. When you add them together, they give you the 1,400. That's the total of non-current assets. Okay, hope we're clear there. Now the one was asking about the net realizable value of plant and machinery. They say that not to. The plant and machinery have a small value of, not a small value, a sales value of 250 million and a replacement cost of 300 million. Okay, and I'm saying, whenever you're given these two figures, if you're considering net realizable value, like we are, okay, we're looking at us, what we're selling at, then you shall consider the sales value. So for plant and machinery, what we can recover is 250 million. And so we're taking. So I hope I've answered you as well. Then to emphasize the issue of inventory, they said that the inventory that we have in our books, the 450, 10% of it is obsolete. Okay, so ideally you're supposed to have this 450 minus 10%. However, they said if you take these clothes and sell them, they give you something, what you call scrap value or whatever you may want to call it. And they will give you just 40% of the value. Okay, so I sort of just reflected in my workings here. Okay, we say that for the workings of inventory, absolute is 10%. Maybe I should put the figures here. 10% of the figure that is in, okay, 450. But what they're giving you in return is 40%. And if you go and sell off this scrap, they'll give you 40%. And 40% is 18. So we're saying therefore the adjustment on the 450 is not the 48 alone, because the ideally you're saying you would deduct the 48, so it's minus 48, sorry, 45, but plus whatever you get in return, which is 18. So giving us a net of 37, of 27 negative. So therefore, our net realizable value for inventory would be this, 423. Explain additional information 3 again. I've just explained it. I hope it's covered still. If it's not, you can still confirm. You can help with that. Okay, it comes from this.
But 27 is a positive.
It's not a positive because, like I said, that the absolute inventory is supposed to be deducted. It's supposed to be removed from 45, from the 450, sorry. Okay. So, however, we received something in return. So if 45, I mean, 45 was going away, and then we receive 18 in return, the net effect is negative 27. So what is going away now officially? I don't know if that made sense. Maybe I should put this here.
Yeah, it's okay. What of the replacement cost? Why didn't you include them?
Okay. So replacement cost, I've just told you that because you're using realizable value, where you have replacement cost and realizable value takes it all. So use realizable value instead. Don't use both. Okay. So we continue. Then continuation after the sale of clothes, 40%. Then they say that the debtors figure contains a doubtful debt equivalent to 4% of their book value. So debtors, which is under current assets, say debtors or receivables. The book value was given as debtors. The book value was given as 250. Okay. Now they say that on the 250, 40% is doubtful. I mean 4%. So just compute the 4%. It is a minus. Okay, something is fishy here. Just a moment.
Andrew.
Yeah.
What others? What did I call the 63?
Just an error. I just did a few things. Just in a short, I'll just correct that. So 4% is that. This one I think just an error. What is it? Is that? Sorry about that. The 4%. So we're okay. So it will be this minus that. So you have 240. That's for debtors. I hope we're together till now. Okay. Then we go to the next note. Now this time maybe I should share the screen for the question. Okay, so they say debtors figure contains a doubtful debt equivalent to 4% of their book value. So I've removed the 4%. Then note 4 says that R and RL paid a dividend of 35 million for the year 2016. Okay, so when you pay dividend, it's supposed to deduct it from our cash. Then they say that the current return to shareholders of companies selling second-hand clothes in the same industry as this company is 13%. So although it is expected that an additional risk premium of 3% will be applicable to the company, being a medium and unquoted company, management of R&RL is seeking for an estimate of the share value of R&L and appropriation or appropriateness of that estimate. Okay, so here our interest is only on the dividend that we paid. Otherwise, the other things do not resonate with what you're looking for. Okay, so because they're giving you the discount rate, which you don't need because you're not going to discount it. So having said that, the dividend, so we have cash of 100 million, but they're saying we're going to make a payment because they're saying that we made a payment, a dividend payment of 35 million. So your cash, if I may share, because what happens is dividends are paid after their end, not during their end, because that's when they're declared and then they're paid in the following year. So meaning that our cash at this point in time was not yet, had not reflected that transaction. So so you have cash, the book value is the book value of cash was 100. Okay, but we made a payment of a dividend of 35. So leaving us with 65. So that's your cash. Now you add, when you add this, they give you the total assets. Okay, and current assets first. And then you add your current assets together. Okay, giving us total assets of non-current plus current. Then go to liabilities. So under liabilities, so as you can see, the additional information was done. So there was no other additional information. So what we do is we come back up and move line by line without leaving out anything. So land and building, we were done with it. Plant and machinery, we're done. Inventory, same story. Direct debtors, cash. And then now we have trade creditors, who are our current liabilities. So you come under current liabilities and you say trade creditors, or we call them payables. The book value was 350. Okay, so they didn't tell us whether we're going to in any way not pay or pay. So the book value remained the same as the reserve value. Then you have the bank overdraft. Okay, bank overdraft, it is still current liability. Okay, and it is 150. Okay, so there are no adjustments, at least nothing was said about this. So meaning that our book value, so our realizable value should be the same. Okay, and that's it. So you still continue. You go to net assets. Net assets, they're saying they're financed by ordinary shares. We don't mind Reserves, we still don't mind. Shareholder funds, that is the equity. So we still don't mind because it's not our interest. Then you have long-term debt of 200. Now that is our interest because it is a liability. So you can say as a long-term liability, it is 200. Are there any adjustments? And so meaning you're going to be paying the same amount.
Otherwise, like in this question, in this net assets, you don't record the equities.
No.
Okay.
Yeah, you don't record. Net assets means total assets minus total liabilities. Nowhere equity comes in. Actually, the value of net assets is supposed to be the value of equity. Okay. So how about the balances on the other side? Vanessa, the balances are totals. They're not actually balances, they're totals. I'll just share with you the question again, yes, since most of you are really having issues with that. This total that you see here, they just come from these. The 1,400 comes from 1,000 plus 400. The 800 comes from adding inventory, debtors, and cash. The 500 comes from adding trade creditors and bank overdraft. Okay, which when you add them together, you come with all of these, they'll give you 1,700. Okay, so these are totals, shouldn't really have an issue. Our issue is on the items themselves, not the total. All right, so let's go back to our question and conclude. Okay, so that is it. So you add your liabilities, when you add them together, you find that when you add them all, total liabilities are 700. Okay, your total assets were this. Okay, keep bold. Okay, so meaning our net assets are equal to total assets minus total liabilities, which is 2,078. Okay. Then, of course, this is not if they asked for the value of the company, you don't stop here. Okay, you're supposed to add there things like self margins. Okay, self margins is when you go to self margin. You're saying if you go to bargain, or if you're going to sell off your company, or if you're in any business transaction, you can't be giving the exact cost of your value of your business as the value. You need to include something what you call bargaining power, or something to bargain with. So self margin may be maybe 20%. Okay, so if it's 20% of this, then we say it is 20% of that, okay, which increases our value to 400. Now on this, you still say, but they have things like an intangible what? Now these additional things are subjective, depending on your bargaining power and your understanding of the business. They're subjective, they're not absolute. So we can have several different answers. Someone can have 10%, another can have 30%. It doesn't matter. Okay, then intangible assets. I would say maybe because strategically located, maybe the biggest in the market.
Pardon, about safe margin.
Okay. So I was still saying, okay, just to repeat for you. Safe margin, you're saying a safe margin arises whenever you have a business transaction that you want to involve yourself into. And the safe margin, if it is a business deal, it is something you leave out for to allow you for bargaining. An example is if your phone is worth 200,000, yeah, and you want 200,000, you're saying if you go to bargain with the buyer, you can't put the figure at 200,000 because you know you may have to bargain. So you put that maybe 300,000. So that if he bargains, when the worst comes to the worst, he will still end at 200,000. That is a safe margin. But the value of the business is 2,078 million. But because we are going to bargain, we are saying our value is at 415. So if in any way you bargain, we still know that you don't exceed or you don't fall below 2078. That is a safe margin. Okay. Then intangible assets. I think you know those. So maybe you give it 10%. Okay, so depending, you can put it either on this or that, depends on the person. I already say this is subjective. Okay, so 10% is on that. So what we do is we now add them together. So total value of the company is saying it is worth, what's that? 2,700. That's the value you're saying we want. So when you go into the a business arrangement, whether you're merging, whether you plan to sell it off, whether you plan to list on the market, we're saying my value is 2,701.4. So in case we are going to sell in the beginning bargaining, you know where to stop. So guys, that is how we determine the value of a business using net assets. I feel it's far easier than cash flows, because of the fact that cash flows are more, they're really subjective. They're supposed to be easy as well, but because of the way they set the questions, sometimes you feel like you're all correct. Why would you ask for more payment apart from the goodwill? Now, goodwill looks at mainly, okay, in our understanding of sale, leave alone IFRS 3 and what, and which one is that? Intangible assets. Fourth and standard. Yeah, IS 38, intangible assets. Leave alone that one. Yeah, there's this one where you go to bargain, and goodwill is said to be reputation, a good name. Yeah. Now we're saying on the good name, you add my customer list. Yeah. Because I already have existing customers, so you're not going to suffer a lot to continue in business. You add my skilled personnel or employees that have left in the business. Yeah. You add maybe a good location. We are strategically located, we're in the city. Add all those.